Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Mike Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital, and joining me today would be Michael Becker. But Becker is up in Dallas, and I'm in Central Texas. So we're on a little bit of a tour of Central Texas and kind of seeing, what's working down in the Austin area. Central Texas probably goes from Waco all the way down to San Antonio. And so I thought we would kind of visit a little bit about what's going on in the Central Texas area. And so I thought we would bring in maybe one or two or three people in the Central Texas area to kind of give us some examples of what their success is all about. So today in the podcast, we have Pradeep Mistry. So Pradeep has owned a number of properties in the Central Texas area. He lives in the Austin area.
Yes.
And he has purchased properties in and around this area. And I thought we would kind of drill down a little bit about what's going on in the Central Texas area and kind of have him share a little bit of his success and what he is doing now. So, Pradeep, thanks for joining us in the podcast.
You're welcome.
So, tell me a little bit about your background. What did you do before you got into the multifamily business?
Before I was in multifamily, I was an engineer, hardware engineer at Dell, and before that at Bell Laboratories, AT&T Bell Labs. I was in that business for at least 25 years, and I did pretty well in that business. But it was a very successful run in that business, but I knew that it would end eventually, and I would have to move on to something else because in the high-tech world, as time goes on, people get let go or laid off, and I was preparing all the time for the future. And I thought the future was in real estate.
What's your educational background? Do you have a bachelor's, a master's?
I have a master's degree in mechanical engineering and with a major in thermal engineering.
So undoubtedly you're the smartest guy in this room.
I wouldn't say that.
So, but, in the engineering business, in the IT business, that industry is susceptible to layoffs. How many times were you laid off in that business?
Luckily, I was fortunate enough not to be laid off until I was at Dell. And at Dell, I had worked there for 12 years, and after that, my job got moved to the Far East. So they had to lay me off.
Yeah, so you weren't going to make the transition to the Far East.
I was not about to do that.
All right. So when you made the transition from the corporate life into the other life, what made you make a decision to get into real estate? Was there other things you were looking at to get into?
I was looking at other ways of having streams of income other than having a full-time job. Mm-hmm. And we had accumulated, saved enough money so we had a pot of money that we could invest in real estate or a business. We had looked at all kinds of franchises, but again, after looking at them, it felt like I was just trading one job or one profession for another one without any freedom. So that is the reason that I shied away from a franchise business, which was turnkey, but I felt like it would not provide the lifestyle that I needed to have in later years.
So of all the things that are out there, whether it is the insurance business to sell life insurance products or sell financial services products, or you talked about a little bit about getting into the franchise business, how the heck did you find commercial real estate as being one of those things to get into? How did you find that path?
So I wasn't looking at it actively, but I was referred to a group that teaches you how to buy real estate, and by a friend who also was trying to do a similar thing. And so we found this group, and I I saw that they were teaching us how to change our careers and teaching us how to buy real estate on our own and make money and have streams of income for us. They would support you all the way through, and so as to say, show you the ropes on how to do things.
So like an educational mentoring group that was going to show you how to acquire properties, rehab properties, operate properties, and then possibly either refinance, pull the cash out, or dispose of the property?
Yes, exactly. And it was a network of people who were just like myself, who owned property and were willing to share their experiences and share their best practices with us or with me. And it was a tremendous uplifting experience for me when I would get around these people, because they were like-minded and they were trying to do the same thing that I was. And they also came from backgrounds that were not really real estate. They were professional backgrounds, like some of them were lawyers, some of them were engineers, some people were in IT. To them, real estate was a way to retire early enough and with your own terms. By that I mean, instead of other people dictating what you have to do, you can choose what you do and how much you want to do.
Yeah, tell me a little bit about your wife, and was she on board with this too?
Yes, my wife was on board with this, and she was also getting tired of being a physician. It was a high-stress job, so we had this plan that she would retire within a couple of years after we got into this business of real estate.
How's that plan coming along?
It is coming along well. Since we decided to invest in real estate, we've purchased 4 properties and invested in other properties also where we did not manage, but we were either key principals or, we just were passive investors.
Yeah, so you're like limited partners in some transactions. Did you do that first, or did you actually want to manage a property and become the managing partner first? I mean,
Since I did not have anything else to do, I jumped in with both feet and started doing both.
Wow, okay.
So what we did is we bought a 24-unit apartment complex in a little town called Seguin, and that was our first property. And at the same time, we also invested in other properties passively.
How do you kind of describe your business model? Are you a value-added buyer? Are you a stabilized asset buyer? Are you a little bit in between? Tell me a little bit.
So we are, the model that I look for is a hybrid. It's never just pure yield play or pure value-added play. It's just somewhere in between where you go ahead and rehab some portions of the asset, and also at the same time, through operational efficiencies, you run that property better than had been run previously and run it professionally. Instead of, because it was just a small unit, 24-unit complex, we still ran it like a business and professionally and did everything that a big apartment complex would do for its residents and tenants.
So in the educational piece, you got your bachelor's, and then you got your master's, and then you were in professional life for, say, 35 years, 35, 40 years. Now you get into the apartment business and you're learning from a mentor educational group. What's the next thing that you do? Do you put together and form a team of people that can support you? Did you have to go out and get your own attorney? Did you get your lender in the deal? Did you get a property management company to look at your stuff? This is kind of like a team sport. Before you bought the property, what did you do?
So, sure, that's a very good question. Before I bought the property, I had really, first of all, the mentor group and mentors that were guiding me all the way through this process, because having never owned, other than our home, any kind of real estate, we didn't have any single-family rental homes or anything. I was just guided. I reached out to the mentors of the group and other like-minded owners, and they helped me pick a loan broker. They helped me to choose a realtor for that transaction. And then there were also operational mentors who were giving me guidance all the way through the process, kind of holding my hand through the process and so till I purchased the property. So it was a very intense guidance from different people, especially since having never run a business. This was a first for me, but it was also because of the team that I had around me, I was able to be successful in this business.
Almost like having training wheels on a bike before you're able to learn
Exactly. They were, this 24-unit complex was our training wheels.
That's right. So let's talk a little bit about some of the properties that you have purchased. Tell me about the first one that you did. Was it the 12 Oaks property?
The first property was the one that I just mentioned a minute ago.
Okay.
And that was a 24-unit property called Landmark Apartments in Seguin, Texas. Mm-hmm. That was our first property, and that's where we cut our teeth on how to manage and run a property.
Did you manage the property yourself?
Yes, we did. We managed the property ourselves. We did all aspects of the management, including the financial, the accounting, the operations, the vendor management, everything. All aspects of the business was done by us.
What was that like to go out of working in an IT position to becoming now a property management company?
For me, it was a really exciting time because I was learning new things.
Yep.
I was learning new aspects of how to run a business, and it was tremendous. And I would be reaching out to all my mentors and my team of realtors, loan brokers, everybody, and they were extremely helpful in helping to manage the business.
So having a team that you think is fairly important.
It is the most important thing to have the right team behind you to buy a property, especially if you're a novice.
That's it. So you bought the Seguin property. Do you currently still own that Seguin property?
No, we since then we've sold the Seguin property and we moved on to other properties. Okay. So we made a decent profit on the Seguin property. It was around 100% of our invested capital.
That's pretty darn good.
Yes, and that was in about 2 years.
2 years?
Yes.
That's good. And what was the next property you bought?
So the next property that we looked at and purchased was, in the meantime, we had been looking at quite a few properties and evaluating quite a few properties in Central Texas and around the Central Texas area, looking for the right returns for that property. And it's so important that when you are looking at properties that you evaluate them and with the help of your team and make sure that it is the right property and that you can be successful in running that property and making money. You do not want to lose money on any of the properties that you purchase.
Right. So the next property...
The next property that we bought was a little property in Round Rock, which it was a 32-unit property. The name was 12 Oaks, and it was a yield play, and so we went in and did all our due diligence and looked at that property and purchased that property on an agency loan. And it was a 32-unit and purely a yield play, very little rehab to be done on that property. We just had to do the operations and make sure that the operations were done, improved, and so that we could improve the income for that property.
Okay, I got it. And so how did you find that property? You know, that's probably the biggest challenge for people today is how do you find the assets?
So, yes, and that is a full-time job also in between when you're trying to buy a property. You're looking at quite a few properties in between, and this one was broker had this property listed, and we bid on that property and were successful in our bid. One of the reasons that the broker the seller was impressed is because when we toured the property, the financing people from our loan broker was, along with the bankers, were also touring the property with us. And that was really impressive to the seller. And they thought that we were really a serious buyer. So that had become a big plus. Usually, you tour the property with just by yourself, but this time we had the bank as well as the broker with us.
Was that us? I don't remember.
Yes, it was you.
Okay.
It was Dave Walls was the person who toured the property with us, along with the bankers.
With the bankers, too. So you think that was one of the reasons why they picked your offer, because you were a serious buyer and you brought your team with you to take a look at the asset?
Yes, that was definitely one of the major reasons, because even the seller was impressed that we had our team with us, and including the bankers.
Now, that was a couple of years ago, but do you remember, did you have to go with hard money into that deal?
Yes, I did. We did have a requirement for hard money up front. The hard money was a little different from the standard hard money type of a deal. The money became hard after the feasibility ended, and also we had to have an additional sum of hard money at the same time. So we had twice the amount of hard money at the end of feasibility.
So you agreed upon a price, you closed on the transaction, and now you're running the property. What were some of the challenges that you found that you didn't uncover before you bought the property, or just some of the challenges, period, that you knew that you were going to inherit on that property?
So one of the biggest challenge, and I hate to say this, but this was a mistake. This was a lack of experience on my part, is that I did not put or gather enough money for rehab or capital expenditures up front. We were shy on the capital expenditures, did not estimate. So estimating and having your team help you with that is very important. It wasn't a big impediment. We were still able to make the cash-on-cash returns, and we were still able to grow the value of the property. And at this time, after about a year and a half, the value of the property has increased by $1 million on a $2.26 million property.
Wow. So it's gone up significantly since you guys bought the property. You guys are operating the property more efficiently. You guys did a Fannie Mae loan on that property?
Yes.
And why did you choose Fannie Mae instead of like regular bank debt?
So Fannie Mae is, of course, one of the things is it's a non-recourse loan, and also the terms were very favorable for Fannie Mae. Also, one of the things that attracted us to Fannie Mae is that if you increase the value of the business, you have an opportunity to get an additional supplemental loan after a year and a half or two that would help you pull some of your original investment out and return it to the investors.
Is that what you guys did?
We are in the process of doing that at this time.
So it was you, and how many investors invested with you?
In this deal, we had 13 other investors.
Okay. And this was, let's say, your second deal. How difficult was it for you to raise cash since you had done a first deal and showed a little bit of a track record?
It was not too difficult because of the mentor group and the team that I had. They did not help me directly with the raising of the capital, but because of the mentor group, I knew a lot of investors who were like-minded and who were interested in investing with me. And having shown a track record of the past property, it was relatively easy to get the money.
What's your occupancy at the property now?
It is 98%.
Unbelievable.
And it's been 100% most of the time that we have owned the property.
So everything's for sale at some price. Is this a legacy asset for you guys to keep? Are you guys going to keep it for a long time?
No, we will sell this property. Either pull the money out from the property or sell it. One of the challenges with a 32-unit property is the operations, a lot of involvement from our team, for me and our team. And it takes up a lot of time and energy to keep the property full and run it efficiently.
Yeah, so smaller properties you would think would be more efficient because you can oversee yourself the property. It actually becomes more challenging to own a smaller property, just like what Pradeep is saying. And so he wanted to have more units. So let's talk about your next deal that you acquired. Which one was that?
So the next deal, we looked at a property. It's an 88-unit property in Bastrop.
And how far is Bastrop from Austin?
It is 30 miles.
Okay.
It's on the east, going on off of 71, going towards I-10, towards Houston.
So it's a secondary market, would you say?
It is a secondary market. This particular deal was brought to us by a broker whom we had been working with on other deals and trying to bid on other deals, and they brought it as a pocket deal to us. So this was off the table, and we were looking at this deal, and we were kind of impressed by what we are seeing.
So the first time, right before the first time you close in a transaction, sometimes you feel like the ugliest person in the room, but then you start to close the first one and the second one, and everybody wants to dance with you.
Yes.
All these brokers, they want to become your best friend. They want to sell you something because they see that you are competent of closing, competent of raising equity, competent of putting the whole deal together. So you become very popular out there. So it sounds like these pocket listings, these transactions that are off market, they don't come often. But when they do, you kind of have to jump on them and kind of make sure that you are able to execute. So the property was not listed for sale, but why did you like this deal?
I like the deal because the numbers look good.
Yeah.
That's the main one. And it was pretty close to Austin. There is growth towards Bastrop.
Yeah, huge population growth going east of Austin, going to Bastrop. Bastrop is a nice little, as I said, secondary community, but a huge road that goes right through it. I mean, it's all going to fill in at some period of time. This property, how old was this property?
This property was built in 1985.
It looks like it could have been built 10 years ago, 10, 15 years ago. The person who owned the property prior to you buying it has kept it in pretty good shape, I remember.
It is in very good shape, and there's also a potential for rent growth in this, income growth in this market, because there's a limited number of apartments, buildings in this market. There are two class A, B/B type properties, and then there are the class C plus, B minus properties, one of which is the 88 units that we bought. So there is no in-between property, and there's no new apartment construction being in that town or near that town.
And so why was the seller selling?
They just wanted to move on to a bigger property, and they wanted to buy bigger, and they had owned it for several years. So that's the reason that they wanted to move on to bigger property.
So with an off-market deal, the buyers are fortunate to be able to get those deals because the seller does, for some reason, maybe doesn't want to show it, promote it into the marketplace, does not want to have the employees be exposed to the market, because you're going to get 10, 15, 20 people who are going to go through the property, ask the manager a series of crazy questions. Maybe the manager doesn't know what's going on. The maintenance person's going to have to defend themselves why they're doing this type of a rehab to the property, or why are they maintaining it? So they kind of keep it quiet, because one thing is that we see that when you do mass market this property to the community is that sometimes those employees get scared because they know they're going to be losing their job, and they all of a sudden, on a Monday they just don't show up because they've already changed companies. So a lot of landlords, owners on multifamily properties do not want to expose the property to the market. Do you think that was one of the reasons why?
That was really the reason, one of the reasons why they did not want to take this property to the rest of the market.
Right.
And
did you have to go with hard money on that deal?
We did not have to go with hard money, because we just had to go with the regular earnest money up front that became hard at the end of the feasibility period.
Well, that's great. I mean, so how did you structure that transaction? It was you and a couple other people that signed with you on that loan, or was it just you by yourself?
So in this particular transaction, because of my experience with many other transactions being key principal.
You keep growing in knowledge and strength.
And also our net worth at this particular time was more than was necessary to purchase this property. So we did not require any other signers on this property. We just purchased the property on our own strength. And
did you have a couple investors that actually said, "Hey, listen, Pradeep, I want to put money in this deal because I've seen your track record"? And
there were quite a few investors. I had to turn many of them down because I did not have room for them in this particular investment.
That's the problem. Success sometimes sucks. It sucks because you have to be sometimes a bad guy to turn people down, turn $50,000 down or $100,000 down. And, not everybody can jump on your train of success, but, we understand that.
Yeah. This property was very nice. The best thing that I think one of the better things that I was confident about when we did the letter of intent on this property, my financial team was already there. I was all approved for the loan. So there was no question that I would not get financing. So we were able to act very quickly on this deal, and it closed in record time.
I love it. What are some of the amenities on that property? I remember it just...
So the main amenity that we have is, of course, our swimming pool. That's the best amenity we have. Also, it's very close to the shopping areas, Walmart and many other shopping areas and dining areas nearby. And so other than the swimming pool, we did not have any amenities. We are planning on improving by adding pergola and barbecue pits and playgrounds for the children of the property. So we are planning on adding additional amenities that people can use.
Have you started to push rents up a little bit in that?
We have. We've gone up by about 5% in the last 2 months.
Holy cow.
The only reason is when we looked at the Class A properties and similar apartments, the difference in the rents was more than $150 for the one bedroom and almost $225 for the two bedrooms. So in this case, we were able to raise the rents, and there was no other alternative in the town.
Wow.
So having said that, while we were purchasing this particular property, we did a market survey in Bastrop. And while doing the market survey, we found the next property that we bought. That was a 56-unit property called Pine Point Apartments. And
now you're managing all these properties, right? You're self-managing?
Yes, we are self-managing the properties.
Okay.
And so the initial 24-unit complex that we purchased really set us up for managing the 32 units and now the 88 units. We know what to do, how to do it. So there was no issues there.
Baby steps. I love it.
Yes. And so while we were doing the market survey, we found this 56-unit property that we thought we could buy. So what we did is we approached the owners through our broker, and for whatever reason, they were willing. They were ready to sell us. They had owned this property for 20 years. And so when we did the market survey, we found that this particular property was in better shape than the one that we just purchased.
Really?
Yes. And the market rents were much, much lower than the property that we purchased. So we immediately saw this potential for increasing rents and increasing revenues without doing a whole lot of stuff in that property. So that's when we approached the sellers, and they were willing to sell because one of the partners wanted out from the partnership. So they agreed to sell that property to us. And since then, we've closed on that property also.
What are some of the amenities on that property?
Again, the amenities are just a swimming pool, but the property is very clean, and it's just a nice, clean property, well maintained. and it's
Now, are you going to have one maintenance person or maintenance person and a half or two people?
We are going to have a team of maintenance, one in each property who back each other up. Also, we're going to have a team of property managers that will back each other up for both properties. So the economies of scale come into play now because we have two properties and we are sharing the personnel between the two properties.
So how did you get that one financed, the new one, and why did you go that route?
So both properties will be financed using the Freddie Mac small balance program.
Mm-hmm.
So the first property was, because it was below, I think it's $5 million, that we were eligible to use the small balance Freddie Mac. And once we did that one, a couple of months later, we again used Freddie Mac because it was again a small balance loan. And we got very good terms on the Freddie Mac.
Did you get some interest only on that one too?
Both the properties, that was the best part of it. We got 3 years interest only.
What does that do for your rates of return back to your investors?
It really enables you to not only improve the property, but also the rates of return go above 10, 11, 12%.
Just on a cash-on-cash return?
On a cash-on-cash basis, yes.
And then it gives you the ability to kind of have a runway to get your rents up over a period of time that you're not having to worry about making principal reduction payments, and you can continue to give good cash flow to your investors.
Yes. And also the other thing is it also helps you add value to the property by taking some of that money that you save in principal and improve the property. So at this time, what we are doing is we are, as the units turn, we are upgrading the units and putting money in the units so that we get all brand new appliances, brand new flooring, just overall making the property better for our tenants. So it's a win-win situation, not only for our tenants, but also for our investors.
So out of all the properties that you own, I mean, you live in the Austin area, but 3 out of your 4 really are in secondary or tertiary marketplaces. Are you thinking about trying to be the king of the secondary, tertiary markets?
Well, it just happens that Austin is a very competitive market. I would love to buy properties in Austin, but it is kind of hard to buy properties and have good returns in the Austin market at this time. So the secondary markets are much better, especially Bastrop is a captive market for us now that we have the lower end of the market covered. Those are the only 2 properties in Bastrop that are Class C.
So you're the sheriff, you're the new sheriff in town, so you can kind of determine really about what's going on in that market.
Yes, and so the best thing about it is we have so much traffic there and so many people wanting to rent with us at that time. It's a good market, it's a growing market, but there are no plans for new construction in that market.
What's the population of Bastrop?
It is about 8,000 people.
So, okay, and Austin is 25 miles away?
About 25 miles away.
Yeah.
It's only about 20 miles away from the airport. The beauty about the location of this property, Bastrop, is many people want to go to South Austin or go downtown. And it is much easier to get to downtown from Bastrop than it is from up north or from Round Rock or North Austin, having to go on 35 and the traffic is horrible. So many people want to live there because it's in the southeast and then they can go to South Austin and work there.
So you bought the Seguin property, you bought the property in Round Rock, the 2 properties in Bastrop. You've done a great job of putting your portfolio together, and I'm sure your investors are very happy, and you've worked very hard. I know you've worked very hard. Any funny stories of all this hard work? Can you think of anything that some people would chuckle at of walking properties, dealing with vendors on properties, dealing with the city? So
people? I do have, I don't know if it's a funny story, but it is to me because I was all set to go And we were concerned about certificate of occupancies in Bastrop, and then swimming pool inspections. And when I approached the city, they didn't know what I was talking about. So we didn't have to worry about fire codes. Unfortunately, we do make sure that we do follow the fire codes. We do make sure that we follow the safety codes that are for the swimming pool, just because we want our tenants to be safe. And
Sure.
But it was kind of humorous that a small town did not have those kind of restrictions on apartments.
And that's what happens in some of these smaller towns, is that they just don't have the codes in place. They just never have had it. And when we as lenders ask for the stuff, thinking it's a large town, and you go run down to the city and they say, what are you asking for? What are you asking about? We don't have anything like that.
Otherwise, I've been not a whole lot of humor at this time. I'm sure as time goes on, we'll come across it.
How about looking back? I mean, you've done a number of transactions now. Any suggestions for people that, like yourself, that were looking to get into multifamily real estate back 5, 6, 7 years ago, like you were? Now you've done it. What are some of the, looking back, I wish somebody would give me some good advice?
Again, I think, number one, you have to have a good team around you. And then also you need to have done your homework. The more details you get into and the more you look at a property, evaluate the property, the better off you'll be when you purchase those properties. It's very important that you do your homework before you buy a property and you have that team that's around you. The one little regret that I had was when I was purchasing 12 Oaks, we didn't allocate or we didn't gather enough capital for rehab. So we are still rehabbing, but the rehab money is coming out of the cash flow of the property. So we're still doing everything we can to provide the best product at the best price.
Right.
But the cash flow, it's coming out of the cash flow, so the returns might be a little less for our investors.
So building a team is probably the most important thing, of qualified people, whether it's your attorney or it's your banker, whether it is your broker or it's your inspector, to kind of figure out what the physical needs are of the property that you're thinking about buying, or even a second pair of eyes from a management company. You may not hire them, but you may hire them to do some analysis on the upfront piece to kind of justify or quantify what you guys have found out. So I definitely agree with you on that, Pradeep. Tell me, we'll shut this down here in a few seconds. What does the next 12 months look for you? I mean, I know that Pretty is thinking about retiring. Is thinking or going to do
no, she is going to retire. Yeah. There's no ifs, ands, or buts about that. Mm-hmm. She's retiring next March. The next goal that I have that we are pursuing is a much, much larger complex, about 250 and above. Wow. 250 apartments and above, because the amount of work that you have to do running a 24 unit or a 32 unit or an 88 unit, especially if you're self-managing, is about the same. The luxury of having a bigger staff is not there when you're having a smaller complex. So that is one of the most important things and lessons that I've learned. So the bigger, the better.
I like that philosophy. The bigger, the better. So, Pradeep, congratulations on your success. You've done a great job of assembling a team, great job of assembling some great assets out there. I know your investors absolutely love you. You've done a great job for them, and we do appreciate your business. Things to remember in the Old Capital podcast is that we're having the fight of the decade for your business between Fannie Mae and Freddie Mac at the Grapevine Convention Center, September 21st. Make sure you look for a memo on that. Second, if you do want to get information concerning multifamily financing 101 from Old Capital Lending, send us an email to info@oldcapitallending.com, info@oldcapitallending.com. That's about a 15, 16-page single-spaced report about how to put together transactions on the financing side. And if you do like what we do and talk about on the Old Capital podcast, make sure you give us a 5-star on iTunes if you like what we do. We appreciate that. Pradeep, thanks for hanging out with us. We appreciate it. If somebody wanted to get a hold of you, what's the best way of getting a hold of you?
Well, they can get hold of me at I can give out my email address or phone number, one of the two.
Email address is probably the best.
Okay. My email address is themistry, THEMISTRY, at hotmail.com.
One more time.
Themistry, THEMISTRY, at hotmail.com.
Pradeep Mistry, thanks for being in the podcast today. I'm Paul Peebles. Have a good day.
Thank you.
Thank you for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitallending.com to sign up for our weekly email updates. We'll see you here next week with another great interview.